Thanks, Kevin, for the interview opportunity. Let's begin by first just understanding what's going on with regard to the shilling's performance against the U.S. dollar.
Yeah, thank you. It's a real pleasure to be back online. I hope you guys are keeping well and keeping safe in all these unusual circumstances that we are operating with. And the shilling has not been left out. For me, a couple of important things that have come into play post-COVID. We, of course, have a significant view from a global macro perspective about what I call risk off. We've seen safe haven currencies and safe haven assets become very valuable. Gold is just up this last few days, it's up about 5% already. And we are starting to see a lot more international players moving towards what you call safe haven. And emerging market currencies such as the Kenyan Shilling have not been left out. That's one part. So there's a global play where a lot of people and foreign investors are taking money to what we call safe haven. The U.S. Fed Reserve has pumped over $6 trillion into the U.S. economy in different forms of bond buybacks, even equity purchases and that sort of thing. So what you typically find is your foreign investors in the local equity markets have ridden the big move up in the month of June and now are taking a profit taking back into the U.S. equity markets. That has contributed to demand for hard currency to be able to remit funds back to the traditional markets. The second part, of course, is you've seen a suppressed dollar supply. Our traditional forex inflows from tourism, horticulture, floriculture, tea exports, of course, will remain challenged over the next few months because of logistical challenges with regards to exports, of course, with regards to demand collapse across European markets, and traditionally in the second half of the year, the shilling always comes under pressure due to these factors. And now you have an exacerbated effect on that due to the COVID virus. Of course, on the demand side, we are seeing merchant import demand. Oil prices are back up, so the quantum oil bill, of course, would have to go up. In the month of April to June, we've seen oil prices go up close to 30%. Obviously, if you're still importing the same quantity of oil, your import bill goes up by that same quantum. So naturally, the amount of dollar demanded will increase. So a couple of factors, as I've mentioned earlier. Number one, there's a global macro play towards safety, risk-free exit from emerging markets. The second is supply of traditional FX inflow. Rich sectors has remained suppressed. And then, of course, you've seen merchant demand from importers. So it's a trifactor that is not helping the shilling at all.
From where you sit, do you see any room for the Central Bank of Kenya to sort of calm the markets?
Yeah, I think in my estimate from observation over the last 18 months, I don't think the central bank is entirely adverse to a weakening shilling. What is very critical for them is they don't want to see volatility. So whether it is a gradual depreciation, that can be accommodated. What you typically see is they would try and intervene in the market where depreciation, like what we've seen over the last 3 or 4 days, where we've seen the market pierce through the 107 into 108 level. So I do expect some intervention in a not so a day or so. But what is critical for our market is what I would call a gradual depreciation that is accommodated.
Good. Beyond the performance of the export sectors, which you've said have really come under serious pressure due to the COVID-19 pandemic, is there anything else that you probably are seeing people reading into the state of Kenya's economy that is forcing the shilling further down?
Yeah, I think the reality that a lot of investors, a lot of followers of the fiscal practice that is currently happening is you've got a couple of challenges. One is we've got Eurobond, and if you don't have traditional export flows where that you can get in inflow-rich FX flows, there's obviously pressure for your external financing requirements. So obviously, a lot of investors, a lot of economists will point towards that as well as a fiscal impact. I think I am personally also concerned that with a significant dip of lack of export flows, one of the biggest positives Kenya's economy had was its ability to bring diverse sources of foreign exchange, whether it is remittance, whether it is traditional tourism, whether it is tea, whether it is for horticulture. We typically found that we had that ability to rely on different sources of FX flow. But now for debt service, you've got reduced revenue generation by the KRA, which would typically be used to service debt. You've got FX suppression on inflow. So from a fiscal deficit perspective, if we see any fiscal deficit as a percentage of GDP approaching 9-10%, there's definitely going to be concern for further weakening of the shilling.
Finally, what do you see as the outlook for the local currency as we get deeper into the second half of this year?
I definitely think 110 is on the cards. Of course, this is depending on COVID, on the economic recovery based on the government's efforts on COVID. And not to say that 110 is a bad rate. I think it's a bit of perception about what do you do with a weakening currency and what sort of fiscal and monetary stimulus can you do to take advantage of that. So I think in the medium term, 1 year, I would look at 110. Towards the third quarter and fourth quarter, I would think that we would remain sort of tapered towards the 108, straddling 108, 109.50 level.